Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I'm delighted to be joined by David Toupin, who is one of the Millennial rock stars right now. So, David is a co-founder with Obsidian Capital, along with Glenn Gonzalez. With David, as young as he is, he has achieved so much in such a short time that it is a feat to kind of see his success. I have personally met him in many conferences and other venues. A little bit about him. David started back in his 20s from the Michigan area. Now he's into Austin markets and perhaps buying nationwide. He has already acquired, by 20 years, he had already acquired a $7 million portfolio. He had his own apartment, small complex as well. And he is now well over into $50 million worth of deals and has raised $10 million of capital as well. His company at this point is buying nationwide in a lot of growth markets. And he also has his own multifamily deal analyzer software, which is also another thing that we will perhaps discuss the details about. So, David, in your own words, maybe share some details about your background and how you kind of came into multifamily.
Yeah, absolutely, man. Thanks for having me on the show here. So I'd say I'm a purebred entrepreneur. I've always run businesses since I could really remember. Since I was 13 years old. Started a landscaping company and grew that. And so I think kind of natural progression, went to college, did some corporate type internships, investment banking, consulting type of stuff. Wasn't a huge fan. I learned a lot and it was a great experience. But for me, I wanted to run a business. Real estate was something I'd always wanted to do. Just seeing people, how successful they were in real estate was very appealing to me. So, listen to podcasts, read Rich Dad, Poor Dad, like a lot of people. And I think I caught the bug pretty early on. I was 19 years old then. So I started wholesaling a little bit, single family type stuff. Really didn't like scratch that itch for me. I really wanted to do larger deals, multifamily commercial. And so when I was 20 years old, I bought my first apartment complex. I pretty much just started talking to owners and brokers and running numbers on deals. And, I found a 12-unit complex and raised some capital and bought it. I had no money in my own bank account, maybe sitting on a couple $1,000 saved up. And so pretty much all the money came from investors. And I put in the sweat equity to get a deal done. And just kept doing it from there. So all I do today is I buy apartments. I develop now. I do ground up, doing a 50-unit ground up and a 150-unit ground up deal. And I started a real estate software company. So
Awesome. Incredible to see your success, and congratulations on all the success you have achieved so far.
Thank you.
It is such a pleasure, and you are such a role model to a lot of folks as well. So now, David, give us some examples, perhaps, like folks who are looking into various markets and stuff like that. What's the best way you suggest folks to get started? Like, what are some of the sort of the groundwork they can lay to kind of get into multifamily game, perhaps?
Yeah, I think there's so many ways to look at this, because there are, a plethora of great markets out there, and there's a lot of not great markets out there. But even to people that you might say, hey, this is not really a great market, to some people it still might be. Let's take Detroit, for example, where I grew up. Right? A lot of people hear Detroit, it's not a good market. In a lot of respects, there's a ton of areas that aren't. But you go out into the suburbs outside the city of Detroit, and there's a lot of fantastic areas to invest, regardless of what metrics might tell you. I've made a ton of money investing in deals outside of Detroit. And so it's because I know the right pockets to invest in, where to invest, where not to. It's kind of the classic, are you on the right side of the tracks or not?
Sure.
If you're north of 8 Mile, you're going to be a little bit better off than if you're south of 8 Mile and you're in Detroit, right? So same goes for a lot of other cities. I have friends that invest in very tertiary markets and do fantastically because they focus there, they know which properties to buy, they buy them for the right price, and they make it work. And then I know people that say, hey, unless they have just fantastic overall growth metrics, unless it's a city like Atlanta or Austin or Dallas or Denver, I'm not investing there because it's not a good enough market. And so there's a lot of ways to evaluate a market. I think that if you're going to look high level and statistically at a market, you're going to find some good places to invest. And I think that's important to do, to know how your city statistically is growing, population wise, job wise, all that. It's very important. But at the same time, when you really get down to it, you can't make every deal happen just by looking at it on Google Maps. You got to hit the streets and know, am I in the right part of town? And the best way to do that, from what I've learned, first of all, by going there and visiting there, I'm always flying all over and looking at deals, different markets, making sure, put my eyes on it. But at the same time, talking to owners and property managers and brokers in that market and asking them, is this a good part of town? And, a lot of times I hear, you don't want to be investing there. And there's a deal that I was really excited about that maybe looked good on paper. But they're like, hey, listen, that's not where you want to be. And so you just got to do your research and realize that, there's data and then there's the hands-on aspect, and you got to have both.
Sure. And I love that aspect. You said there's data side and there's obviously the human intelligence side, that what folks are telling you, they're advising, are you on the right side of the tracks and things like that. So speaking of that, let's say the human component of it, David, are you continuously sort of networking with brokers, or what are some of the things like, as you said that you are traveling all over the place to all the different cities and stuff like that. Could you maybe perhaps share that what are some of the questions you are asking brokers? Are you perhaps looking at some OMs and saying that, hey, the price per unit looks pretty good. Let me, connect with a few more brokers and understand what's in the market. What are some of your sort of back of the hand things that you're constantly doing on a daily basis when you're talking to brokers?
Yeah, I think in terms of like looking at a deal, I think, anytime you look at the first deal in a new market, it's almost impossible for you to know, like, is it a great deal or not, right?
Sure.
I mean, you might, if it's like a really phenomenal deal, it might pop out to you. But at the same time, what I've always figured was I'm really going to have to look at 10, 20, 30 deals in a market to really start getting an understanding of what things sell and trade for in certain markets.
Sure.
Price per unit, where the rents should be, standard rental rates, where can I get the rents to? What should my expenses look like? What do property taxes look like across 30 B-class properties in Indianapolis versus Austin? It's going to be significantly different.
Sure.
Austin, I might be averaging $1,600 to $1,800 a unit on the taxes, which is absolutely crazy, but it's true.
Sure.
And in a city like Indianapolis, I might be at $800 to $1,100 a unit on taxes. And so, I'm just looking at a lot of deals and a lot of data points and being very hands-on with that as an owner and a buyer. But things I'm asking brokers, same kind of thing, like what's a good area to be investing in? What do you see? Why do you see this property as a good deal? Like, just explain it to me. What's the story behind it? Sure. That's one of my favorite questions. And it's probably one of the first questions I ask every broker is, what's the story behind this deal? Why do they want to sell?
Sure.
If they're the typical syndicator owner and, they went in, they renovated 50% of units and now they're trying to sell for max value, top dollar, and they're putting it on market with a call for offers. 99% of the time, that's not a deal I want to buy, honestly. Every deal I've ever bought that has made myself and my investors a lot of money have been off-market deals with a good story. The broker brought it to us because we had a relationship with them and timing worked well and we owned something in the area, and they're like, hey, check this out. This owner's ready to sell. You need to move fast. And we get it locked up and it's a great deal. Stuff like that. a lot of the typical deals where it's like call for offers, marketed bidding wars, like that's not really our typical vibe. So I'm really just digging into the owner more than just like, hey, what can we do with this property? What's the story with it?
Sure.
How well do they take care of it? Are they good
Mm-hmm.
owners, operators? Who's the management company?
Mm-hmm.
They self-manage it? Is it mom and pop? Is it professional management? Stuff like that.
Sure, sure. So now speaking of that, sort of the mom and pop owners, or perhaps, we talk about legacy owners, like, they've been, I mean, like perhaps as we know that sometimes these multifamily assets have been in the family for perhaps sometimes generations for that matter, right? So are you doing any off-market sort of activity in terms of like, say, are you doing any marketing or anything like that? Would you advise to do that, or perhaps, or just go straight to the brokers?
We do both. I like to hit them in every direction. So we've got tons of broker relationships in each market that we're always in communication with. But then we've got a really strong off-market targeting system. And so I've got a team of 10 people.
Mm-hmm.
It varies anywhere between 7 to 10 people at any given time.
Sure.
Acquisitions people that their sole job, I provide them with lists of owners and phone numbers. Their
Mm-hmm.
job every week is to call 50 to 100 owners
Mm-hmm.
each and get in touch and ask, are they open to receiving an offer from us? So,
Mm-hmm.
we make 500 plus calls a week, our team. My structure with them is if they bring a deal that we end up buying, I'll bring them in on the equity and give them a fee up front as well. And so I'm kind of educating them along the way too. These are other people, young people or people that want to get into the space, into multifamily ownership and want to learn about it. And so that's kind of how that's structured. And then I also send a lot of mailers. We have a machine that stuffs, tons of mailers. And so we send out, about 500 a week when we're in acquisitions mode, direct to owner.
Sure,
So.
sure. Thank you for sharing that, David. And also, like now, speaking of underwriting, David, that you obviously have developed your own underwriting software as well. What are some of the things that you were thinking that you need to have your own flavor of underwriting, and what was something that you did not like about existing underwriting softwares, and you kind of decided to kind of jump on and have your own software as well?
Yeah, so I think that's one of the things that from the start has kind of been my strength is the numbers. And
Mm-hmm.
so I've never used anyone else's tool because when I started 4 or 5 years ago, I just had a very simple spreadsheet that I had built myself.
Mm-hmm.
And it kind of just grew and grew over time to the point where I actually started selling it.
Sure.
And in the past year and a half, I've sold almost 6 figures worth of a spreadsheet
Mm-hmm.
through word of mouth. And
Awesome.
so
Mm-hmm.
what I decided to do because of that was that 95 to 99% of people still use Excel in this. It's a very dated industry, private equity, real estate, this type of stuff. And so in some ways, and on the equity and investment side. And so everyone's using Excel, and in my mind, software is a much better solution.
Sure.
So I started a company last year called Real Estate Lab. And
Mm-hmm.
our sole goal, we're developing about a $500,000 software program right now. It's just our first version.
Mm-hmm.
And it's going to solve the underwriting process for a lot of people. It's going to make it easier. It's going to, for people that hate Excel, that don't know how to underwrite deals, that want to get into the business, but that's like a big hurdle for them.
Mm-hmm.
This is the solution. And it's also going to help people that are already sophisticated analyze more deals quicker and more organized. And so it's all web-based. You can upload T12 and a rent roll, which are the main financial documents that the seller provides you or the owner provides you,
Sure.
or the broker, to analyze a property.
Mm-hmm.
You upload them, it'll read it, it'll pull out the key data, the unit mix, the rents, everything. It'll put them into the analyzer for you. You make a couple of assumptions, and you can generate reports, look at your returns in real time
Mm-hmm.
as you make assumptions. And so send LOIs through the software, track all the deals you're looking at on a map.
Mm-hmm.
So it's a full multifamily acquisitions platform from start to finish.
I see. I see. Awesome. Sounds very interesting. So now, speaking of, sort of the markets evaluation, David, and things like that, what are some of the things you are looking for in terms of like different submarkets and stuff? Like, are you looking for like a good story? Are you looking for like rent bumps in potential assets? What are some of the things that jump out to you when you are looking at different submarkets?
Yeah, I like well, in terms of the market itself, the submarket, I really like B areas.
Hmm.
I don't really play much in C areas anymore. So I like B areas, something where you could very safely walk around at night and you wouldn't feel uncomfortable. That's
Sure.
kind of how I would describe it.
Hmm. Hmm.
Something where the class of tenant treats the property with a little bit more respect, I'd say. And so, the quality of the asset, I think, is maintained a lot better over time.
Sure.
And so you pay a little bit more for these properties, but if you find the right ones, there's always kind of a dog in every market like this. There's always that one property on the street that's not as well taken care of. And
Hmm.
that's the one that I like. And
Hmm.
so I can go in and everyone else is renting their 2 bedrooms for 1,000, but mine here at 800. I can go
Hmm.
in and renovate them and get them up to 1,000.
Sure.
Um, and so that's what we're looking for. We're looking for value add properties where I could buy at a wholesale discount. I never pay market value for any property. I
Hmm.
always buy at a discount. And the way to do that is you just look at a lot of deals and
Sure.
you find the one that's good and where somebody is either willing to or unknowingly selling to you below market value.
Sure. Sure. Now, the whole aspect about selling under market, or perhaps you're dealing in multifamily, sometimes you are definitely dealing with a lot more sophisticated owners and things like that. So what, like, as you're looking at sort of the deals and let's say you're looking at a rent roll or T12 and things like that, what are some of the things that you would advise that investors should look at, and I'm kind of referring to all the details that go in on that, whether it's let's say the contract services, the payroll, whether their maintenance is high and things like that. Can you perhaps share some key data points that you look for?
Yeah, on the underwriting, the biggest things I look at are going to be, where are the average rents right now for each unit type, and
Hmm.
where can I get them?
Hmm.
I think that's probably one of the first things that sets your top line revenue number. Like, where can I get my revenue to on this property?
Hmm.
Um, what are other ways I can add or increase revenue other than just rents? Can I bill back utilities?
Hmm.
Can I go in and put all new low flow toilets in and reduce our water sewer costs, maybe
Sure. Hmm.
stuff like that. Can
Hmm.
I add storage lockers, or can I add pet fees, or is there something that they're not charging that's typical that I could charge and there's a market for?
Hmm.
Um, and the next thing is, you go down the income statement, you got the expenses next right after the income.
Sure.
So
Sure.
the expenses, some things I'm looking for is normalizing your taxes. So
Hmm.
where are my property taxes going to go after I buy the property? Most
Sure.
times, and most states, I mean, it's different everywhere, but most states, they get reassessed after you buy a property,
Hmm.
and your
Hmm.
taxes can go way up depending on where they were before and where the market's at. So you got to kind of figure that out. That's its own little equation, and you gotta kind of talk to the assessors and figure out exactly how to calculate that.
Sure. Sure.
Um, but really, when I'm looking at expenses, I'm looking a lot of times at a metric, which is a per unit cost, annual per unit cost. So let's
Hmm.
say I have 100 units and my taxes are, or let's say my insurance is 100,000 a year, which is a
Hmm.
bad example. But it would mean that my per unit annual cost for insurance is $1,000, which
Hmm.
is really high, I would say, for pretty much any property.
Hmm.
So we're normally in the 350 to 450 per
Hmm.
unit
Hmm.
annual range for insurance. So, and that kind of leads to that point, right? I know across the board in all these different product categories, repairs and maintenance, insurance, advertising, marketing, contract services, turnover, like what are those average per unit costs? And so I can go into really any property, even if you didn't give me financial statements, I could probably tell you within a decent range what it should be operated at.
Sure. Sure.
And most properties overall per unit operate in the high 4,000s to the high 5,000s, I would say.
Hmm. Hmm.
Somewhere in that range is a good average.
Hmm.
So once you start looking at these enough, you start picking up on these metrics and you start seeing trends.
Sure. Sure.
And that's when you become really good and powerful at underwriting. So when you start noticing the trends and you can quickly evaluate a deal and find out what looks right, what looks off, what can I change.
Sure. Now, also, related question, David, is that a lot of times when you're looking at, let's say, the broker's OM, you are seeing, like, especially the pro forma, brokers are like literally saying, hey, the bad debt is really minimal, or perhaps, really obscene rent bumps and things like that. So what are some of the tips and tricks you can share when you're sort of looking at the OMs that you can kind of share with viewers?
Yeah, I mean, I think the first thing is I'll read some of the descriptions and the some of the data points that are like factual in terms of the structure of the building, the square footage, the unit mix. When was the roof last replaced? What was recent CapEx that was done? In terms of the brokers' pro formas, I mean, no offense to all the brokers that I work with, but I never look at them. I haven't in years, to be honest with you. I make my own, and I work off the actual financials that property or that they've given us, the actual property financials. I'll never look at a pro forma from a broker, because their job is to sell the property, and so their numbers are going to reflect selling the property, right? They're going to make them look good and nice. So I always do my own numbers. I never look at those.
Got it. Now, speaking of, sort of the new development that you're doing now, David, why perhaps that excites you more than just keep like, for example, buying, more and more multifamily existing assets? Like, why kind of venture into new development? Could you maybe share your sort of thought process into it?
Yeah, for now at least, we probably still do 80% of our main businesses existing and 20% new development. I see the 20% new development projects; those are all going to be very long-term holds for us as a company, and we're investing a lot of our own cash into those deals. Because they're brand new, good quality, it's something that we can hold for 20 years, not really have to worry about a lot of large maintenance issues. It's not talked about a lot, but the reason a lot of people do these 3 to 5 to 7 year life cycles on syndications is because, once they get into a property, they raise enough capital up front to do a lot of the major CapEx, but, they're not planning from day one to do the roofs in 10 years when they need to be redone. If they've only got 10 years left, they're hoping that they're going to sell it in 5 and the next buyer is going to do that. So to have an asset that's brand new, and we can hold it for a long time and not have to worry about a lot of the physical aspects, I think is important, but also they provide really high returns if you buy the right piece of land and build them right, lease them up in a good area. And so we're only building right now in Austin, which is a high growth market. And I could see us doing a couple $100 million development in the next 3 to 5 years, just in Austin there. I'd really like to continue building in Austin, a big portfolio.
Absolutely. And there are plenty of reasons why you should definitely do all that there for sure. Now, speaking of property management and sort of looking over the existing assets and stuff, how are you kind of interfacing with your existing property managers? What are some of the reports and things like that you look for from all your property managers on a continual basis?
Yeah, so we have an asset management team in-house that does all of the interaction really with the management companies after we close on an asset. And so the interaction really is probably done with every property a couple times a week. We'll communicate with if not almost daily, communicating with the regional managers and the on-site management team, and oftentimes the back-end accounting office with the management company, reviewing their weekly cash positions, profit and losses, collection reports, occupancy status trackers, all that kind of stuff, and status of renovations. If we're doing a unit renovation program currently, we're renovating vacants. All of that is being communicated on almost a daily basis, I'd say, with the management companies. So we always know exactly where they're at, and we're taking the data they give us and we're putting them into our own, software and trackers and stuff like that. So we really know the exact position of the property at any time we have a snapshot. So what that does is not only keeps us in the loop and informed, and allows us to make really good decisions on, where the property should be going, how our expenses doing, what do we need to cut, what do we need to push. But it also puts a lot of pressure on the management company. An owner that communicates with them once a month or once every other month is not going to get the same amount of attention as somebody that's communicating with them every day and put a lot of pressure on them. So
Sure.
that's part of the strategy as well.
I see. So very close relationship with property managers and working with them almost hand in hand, kind of. So you are hands-on more or less, and kind of working as a partner with property managers. So that sort of close relationship and keeping them on their sort of checks and keeping them on their toes is kind of
exactly. And we also tour the properties, once to twice a month, once every week, a lot of times in the beginning. But then, once it's more stabilized and running once a month or twice a month, we're at the property itself, physically inspecting and making sure that everything's good, bringing up items that maybe they missed, stuff like that.
I see.
Just meeting, the on-site managers really like to meet with the ownership group too, and they like to know that the owners care.
Absolutely,
and that's important. They're employees on site and they're working for you, so we want to show them that we do care and that their hard work is appreciated and important to us.
Absolutely,
and what they do is extremely valuable.
Couldn't agree more. Now, on a related topic, like let's say when you purchase the deal, there is always some aspect of improvements that we have to do, right? So whether it is some parts of exterior and perhaps a lot of like cosmetic upgrades within interior units and things like that. What is your sort of favorite way that you proceed? Are you doing perhaps exterior improvements, whether it is landscaping or sort of seal coating your driveways, things like that, improvements to leasing office and stuff like that before you move into interiors, and I know this can be sort of change on asset to asset depending on what that asset requires, but what is some of your thought process behind sort of starting with your capex improvements?
So going into it, we determined a pretty thorough budget even before we make our first offer. I like to sometimes we'll be very conservative based on like photos and stuff and make an offer, but a lot of times we'll actually tour the asset itself. And my business partner who's very good at this, we'll just eyeball a lot of things and put a renovation kind of a budget number to it, right? And then once we get a property under contract and actually get it bid out and new items maybe come up and stuff, we kind of mold that into a more solid budget by the time we close, and then we have a final renovation budget. That's given to the GC, and so at that point, really, we put a chart or timeline together, saying, okay, we have $500,000 in exterior and common area improvements. Maybe that's seal coat the parking lot and stripe it, repair siding, replace X amount of broken windows, paint the railings on the stairwells, paint the common areas on the inside, redo the leasing office. And so we kind of have a timeline for all that to get that going right away and be completed as soon as possible, because the more we can improve the appeal of the exterior of the property, if it's lacking in that area, the sooner we're going to attract more residents and achieve those higher rents. But in the meantime, while we're doing that, we're still starting right away off day one with any vacant units. If our plan is to renovate units, we're starting to renovate units day one. And what we do to throttle how many units that we renovate, maybe we're renovating units and they're not leasing as fast as we would like, or we're not really fully hitting our rent and it takes an extra week to get our rent. We're gonna start dropping. What we do to throttle that is we drop our renewal rate a little bit. So maybe they're at 800 and renovated, it's going to be at 1,050. We might say, hey, if you want to stay and to force vacancy, we might say, hey, your renewal rate is 925 or 950, and maybe 20% of people will say, okay, I'll pay that and stay. The rest of the people are either going to leave, or they're going to say, hey, if I'm going to pay 950, I might as well pay 1,000 or 1,050 and get the renovated unit. So if we don't want as much vacancy, and we don't want to renovate more units because of the fact that we're not hitting our rents as fast, we'll start saying, hey, we'll just renew you at 825 or 850, right? And we'll have a lot more people stay around.
Sure.
And so that's kind of our throttle. If we are hitting our rents right away and releasing fast, we'll say, hey, you got to renew at 950. Like, that's hard. Like, you either take it or you leave it. It'll force a lot of vacancy from old tenants.
Sure.
and then we'll renovate more units and achieve a higher rent.
Sure. Makes sense. Now, speaking of the COVID pandemic, David, as we all know, a lot of tenants are affected in terms of, whether they have job losses or
Sure.
hours being cut and things like that. So it is hitting the books in terms of, some people are late or perhaps not able to pay and things like that. So typically, as we say, the C class perhaps is a lot more affected than typically a B class property and things like that. So as we move forward through the year and kind of seeing the effects of pandemic, as we are underwriting the deals and stuff, we know that the NOI is kind of fluctuating quite a lot in a lot of places. How do you sort of see this playing out? How can someone safeguard against all of some of these gyrations that are happening?
Yeah, I mean, I think we've found a lot of ways as a country to open a lot of things back up as opposed to what was closed in April, May.
Sure.
So we've got a lot more things that are open. We've still got a high unemployment rate compared to where we were at before, obviously. People aren't making as much. A lot of jobs were cut. So, and a lot of businesses still aren't able to be open. So there's not as much, money circulating, and that's going to cause issues with people paying their rent.
Sure.
So I think what we're going to see happen, because I believe just 9 days ago, mid-July, the stimulus money, that extra check every week ran out, right? They stopped paying that. So I think what we're going to see coming through the end of this month and in August is going to be a decent, I don't know if it's going to be massive, but a decent dip in collections and, rental increases, I think, are going to be almost non-existent the next month or two.
Sure.
So I think what that's going to either do is once people start seeing, government money is stopped and the economy is actually, not unrealistically inflated by the government money that they're channeling in, I think we're going to either see more businesses, we're going to see a bigger negative effect, which I think is going to push more businesses to want to reopen back up, and they're going to get creative and force themselves to open back up in creative ways, which will only partially solve the problem, or the government's going to pump more money in, which is really still just another temporary solution. So, and I think everybody's trying to do is just buy time till we get a vaccine, right? So I do think we're going to have a tough August and September. Our collections were fantastic. March, April, May, June, they went a little stagnant, and July so far, they've been a little stagnant on point with June. So I think August my prediction is going to go down a little bit, but we'll see.
Good. Awesome. And do you see this pandemic sort of giving ourselves into some more opportunities, let's say in 2021 or 2022? What do you see sort of the midterm layout? I mean, I know you're networking with a lot more investors and things like that. Do you see this pandemic giving us a lot more opportunities coming forward?
Yeah, I always think with struggles like this come a lot of opportunity. I'm a very opportunistic person. And so I do believe a ton of opportunity is going to pop up. I think it's really weird, though, because we've been artificially propped up. And so people, things have changed a lot significantly. Like the fact that you can't go into a property and just charge whatever rent you want, get it anymore. I think that is a big change, right? And we can't be predicting 3% rent growth every year. I'm predicting 0% rent growth for the first 2 years in a lot of these deals that we're looking at now. So with a lot of those facts in mind, a lot of sellers are still unrealistic with their pricing expectations. And there's a gap. There's a big gap. So you're either having to find people who are in really distressed situations and you could get a deal because of that. And they're really motivated because of something, or they're motivated because another opportunity came up. They want to take advantage of it. They want to sell something quick. I mean, or you're taking it, classic, maybe more mom and pop scenario, which we bought out of those type of deals. So I think that there's still a big gap. I think opportunities are there to be had for sure for those who are looking hard. But I still think there's a weird kind of thing going on right now. Some people are still paying high prices for properties, and I just don't think it's justified. Same as they were doing in 2019, but almost even worse now. It almost seems really even dumber.
Sure. No, it is a risky proposition sometimes to kind of continue doing same thing given, what has happened. And I think sometimes, as we all like to say that, patience can, have its own rewards. And, trying to be impatient and just to do a deal to just kind of get into a deal can be disastrous. Would you agree?
I agree. I mean, you got to always be very conservative and realistic. I think that's one of the reasons that all the deals I've done to date have been successful, is just because I'm conservative and very logical with my assumptions, and we take a lot of precautions, like big rainy day funds and reserves and stuff like that. And so we don't over leverage.
Sure. Sounds good. So thank you, David, for coming on. It is a pleasure to always network with you and see all the bigger, better things you are up to. Kindly share with our listeners, how they can find you and learn all the things that are going on around you.
Yeah, the best way is Instagram. Follow me at Real Estate Jedi, or you can check me out on my website, obsidiancapitalco.com. It's spelled OBSIDIAN. And hit me up there, hit me up on Instagram, go on Facebook, David Toupin, YouTube channel, David Toupin, and would love to hear from you.
Awesome. So thank you for coming on, David. It is a pleasure to always network with you.
Thanks, my friend. You as well.
See you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.